On Business Incorporated today, World Bank approves $9 million to fund Liberia's health sector. And fuel prices in Tanzania rise to record levels despite fuel subsidies. Now, Egypt's non-oil private sector suffers its worst performance in 2 years. Hello and welcome to the program. I'm Will Ibong. We kick off as always with market numbers from Africa, where trading sentiments were mostly in the green. Nigeria's NGX was trading marginally up at 0.03% after its bearish close yesterday, while South Africa's JSE jumped over 1% at intraday. Elsewhere, Egypt's EGX 30 was down at intraday. Its index fell by 0.23%. Kenya closed Tuesday's trading session in positive territory, up 2.3%. Meanwhile, delegates from Ghana's capital markets paid a visit to the Nigerian Exchange Group and participated in the closing gong ceremony, where a host of issues were discussed, ranging from Africa capital integration and others. On the issue of regional integration of capital markets in Africa, the Director General of the Securities and Exchange Commission in Ghana says sub-regional integration must be tackled first before full integration. Let's take a listen.
Well, in terms of achieving integration across the African continent, what I would say is that one of the schools of thought has been to first address integration in the various sub-regions. So we have been focusing on the West Africa sub-region. So we have the West Africa Capital Market Integration Council, which is made up of the capital market operators, and then the West Africa Securities Regulators Association, that's the regulators. And we've been working together on ensuring that within the sub-region, that's West Africa, we achieve integration. And it will be easier to leverage on an integrated sub-region when we are looking at the African continent as a whole. There were three phases that the WACMIC WASRA effort identified. Phase one, which is the sponsored access, that's where a broker trades through another broker in another jurisdiction. And the second phase is the sponsored qualified West Africa brokers phase, where a broker would be admitted as a trading participant. And then the third is the ultimate, which is the having one virtual or one integrated.
Now to the Middle East, where it's mostly negative sentiments observed at intraday from major equities in the region, with Saudi Arabia as the only gainer. The Abu Dhabi and Dubai exchanges were down at intraday. Both indexes fell 0.21 and 1.92% each. Meanwhile, Saudi Arabia's index rose by 0.42%, while the Qatari exchange traded in opposite direction, down by over 1.6% at intraday. Over to Europe, where the euro is down to a 20-year low against the dollar, as new figures point to a further slowdown in business and also raising fears of recession. Stephen Beardsley is in Berlin with more insights. Now, Stephen, what other factors are driving further depreciation of the euro against the dollar?
The euro on Tuesday reaching a low of $1.03, just below it actually. That's a level that it hasn't seen in nearly 2 decades. The last time was at the end of 2002. Now, this was not a plunge that just happened suddenly. This has been in many ways occurring over the past decade plus, one could say. The height of the euro against the dollar just right before the recession of 2008, 2009, but also the euro crisis a few years later when Greece threatened to leave the eurozone because of its overwhelming debt. That also brought it down even further. Now, more recently, as you probably know, it's because of what's going on in Europe, the war especially. and then fears of a recession, which are both tied to that war and also tied to general supply chain problems because of economic recovery, corona recovery. So those issues with the war, of course, relating for the most part in Europe with gas and with energy supplies. Those prices are rising quickly, and that's really making it difficult for businesses and households to keep up. Not only that, but there's a threat that it might actually be turned off and there might be scarcity, and that means that businesses might have to ration their use, stop some production altogether. It means that even households could be affected. Those fears are helping push down the euro against the dollar. We should also add that the dollar has strengthened in recent weeks. One, because it's a safe haven that's often turned to in times of economic turbulence, and also because of recent rate hikes in the U.S. And the prospect of rate hikes that tends to strengthen a currency.
So what does the lower euro mean? You've mentioned implications for businesses, but what does it mean for the businesses, especially on the continent, on the European continent? How are they facing this? What does it mean for these businesses now, Stephen?
That's a good question. For most people, it probably won't mean anything or much at all in their day-to-day lives. For those who are buying any items that are imported in dollars and paid for in euros, then they could have to shell out a little bit more for those products. In theory, dollar-denominated debt would be a problem for anyone paying that. In Europe, that's probably not such a problem. Otherwise, it could actually be good news for some parties, especially for exporters. That is, those businesses who are selling their goods overseas and don't have a whole lot of exposure to those local markets as well. So in theory, it's a good thing for exporters, which again would seem to benefit Germany being a major export land, although a lot of its companies also co-located in the places where it's selling. So the benefits aren't always abundantly clear. But in general, good for exporters, bad for importers is one of the rules that you often learn when it comes to these currency issues.
So I'm sure investors are watching. So what, with these recession fears, what are the reactions in the market at the moment?
Yeah, it depends on where they are. In the U.S., they're watching gasoline and oil prices. Oil prices actually falling yesterday pretty dramatically. That will help at the pump. That's also another sign that recession is probably around the corner. That's the bet that investors are making. If you're in Europe, you're watching what's going on in Ukraine, and you're watching this drama that's unfolding between Germany in particular and Russia. But of course, that applies to the whole EU. These fears that the gas spigot is going to be turned off in the coming days. The German government really stressing this point recently, saying that it fears that the pretext of a maintenance on one of the major pipelines going from Russia to Germany will be used to actually turn it off altogether. So that's really driven up fears, and that will drive up fears that inflation will follow, because those prices will go up, and that could put more pressure on the currency and on the central bank here in Europe to act. And in turn, when the European Central Bank raises rates, that is a threat to borrowing rates of some of the weaker countries in this Eurozone. So sort of a domino effect that people are keeping an eye on. General inflation, they'll be keeping an eye on prices. But there also may be opportunities as equities get hit harder and harder to buy the dip in some cases. And there may also be occasional signs that may portend that there is, in fact, no recession coming. In fact, the DAX and most European indexes today starting out in good positive territory after some positive reports on German industrials. The orders up in the last month compared to previous months, and that's an unexpected bit of good news when most countries are seeing mostly bad news when it comes to the economics that they're seeing right now.
Oh, thank you so much, Stephen, there in Berlin with those updates. We'll look forward to more market reports tomorrow. Thank you so much, Stephen. Now we scoot a little bit to the UK, where it's still a buzz with the news of the resignation of the UK's Health Secretary, Sajid Javid, and Chancellor Rishi Sunak. And Juliana is standing by with the latest development. Now, Juliana, what is the update on the resignation crisis at number 10 Downing Street?
Good afternoon, Will. Well, just about an hour ago now, the Prime Minister's questions has just come to an end. And unsurprisingly, it was a pretty bruising spectacle and back and forth between those who want to see the demise of Boris Johnson and him trying to defend his political career. It was uncomfortable at times, brutal at other times, but the Prime Minister made it pretty clear that he is going nowhere. Besides him, of course, was Nadine Zahawi, who has succeeded Rishi Sunak and become Chancellor of the Exchequer at a time when, the country is going through its worst cost of living crisis in a generation. And that's what the Prime Minister was trying to pivot towards. He wanted to talk about the issues that are impacting ordinary Brits up and down the country. But it was pretty impossible because, of course, everybody, including three of his own Conservative ministers, were asking him to do just that. So it was very, very difficult. It's not over for the Prime Minister. We are expecting another public appearance when he will be sitting in front of the Public Select Committee talking about Partygate, which hasn't gone anywhere. So the political scandal engulfing Downing Street hasn't come to an end yet. Some people are saying it's not if, but when Boris Johnson will be ousted from number 10.
Juliana, this is bad timing for Boris Johnson and bad timing for the UK as well. We hope he has some reprieve or respite from this, and we'll see how the events unfold, as you've mentioned. But I'm sure markets are churning somewhere and reacting to these news and updates. What are you seeing at intraday, Juliana?
Well, surprise, surprise, Will, the markets are doing pretty well. Perhaps investors are looking forward to perhaps there being some political change in number 10. Nobody knows why, depending on who you ask. But yeah, the FTSE All-Share is actually in positive territory at intraday. It's up 0.68%, triple-digit surge on the FTSE 100 and the FTSE 250, the domestic market. The FTSE 100 is up by over 1.8%, and the FTSE 250 is up by over 1.3%. In the currencies market, the British pound still lower against the US dollar, lower by 0.32%, though we know that the euro is not doing pretty well at the moment. So the British pound is faring higher against the euro by 0.33%. But at intraday, the British pound is also lower against the Japanese yen by 0.41%, Will.
Thanks so much, Juliana, for that update. And I'm sure you will stay on to give us developments and more juicy stories later. Thanks so much, Juliana, for joining us. Now to Asia, where Greater China stock indexes led losses as COVID concerns resurfaced, while Asia-Pacific markets traded lower today, especially Wednesday. Hong Kong's Hang Seng Index slipped more than 2% earlier in the session and was down 1.22% to close. Mainland China markets also declined. The Shanghai Composite shed 1.43%, and the Shenzhen Component lost 1.25%. Shanghai will be conducting mass testing in several districts after COVID cases were detected earlier this week. Japan's Nikkei 225 fell 1.2%, and the Topix index slipped 1.23%. In South Korea, the Kospi declined 2.13%, while the S&P ASX 200 in Australia was 0.52% lower. Now, U.S. equities futures were little changed early on Wednesday after the market staged a big midday reversal on Tuesday, with falling bond yields giving a boost to growth stocks and ahead of a batch of economic data. Futures tied to the Dow Jones Industrial Average were close to the flat line, while the S&P 500 futures and NASDAQ 100 futures were positive. Meanwhile, let's have a quick summary of yesterday's trading activities with our correspondent, Maria Bird.
The U.S. stock market was mixed on Tuesday, as two of the three major U.S. indexes had to rally toward the end of the day. But the Dow Jones just couldn't make it and closed down by 0.41%. The S&P 500 just slightly up at 0.15%. The heavy tech NASDAQ was up by 1.74% on Tuesday. It is clear that investors are a big concern because oil prices also fell on Tuesday. It is perceived that the economic growth slowdown is going to have a direct impact on energy consumption.
Thanks so much, Maria. Now we'll take a quick break, and when we come back, more stories from the African continent. To stay with us. Welcome back. Tech has become the buzzword, especially since the COVID-19 pandemic accelerated it and is driving digitization in Africa. Africa's digital economy is large and is growing with an estimated market size of $115 billion, expected to reach $712 billion by 2050. Also, 1 in 6 of the world's internet users will be in Africa in 2025. This is according to the latest report by a global organization of high-impact entrepreneurs, Endeavor Nigeria. How far or how close is Africa to achieving this? Eitayo Gumala, Web3 evangelist and CEO Utiva, joins us to discuss this. Hi, Eitayo, how are you doing today?
I'm well, thank you, Will. How are you?
Now, recent report shows Africa's technology sector will record massive growth to the tune of about $712 billion by 2050. Do African economies have the right infrastructure to achieve this?
Oh, yes, that's a very interesting and tough one. But permit me to stay within the frame, of that report. You see, the dynamics that play into this forecast are a little bit different. We are talking about the market size of the African tech ecosystem, which is quite very massive. A population of 1.2 billion people, a very youthful population. There are some other factors that play into this report. You're thinking about the rising smartphone adoption, internet penetration on the continent, and the quality of entrepreneurs and the size of the problems that these entrepreneurs are solving. The payments, fintech, e-commerce, education, transportation. It's like in an economy where there are a lot of problems, there are massive, opportunities. I actually think that we need to start to think out of the box and begin to think much more Pan-African, because as a continent, there are certain opportunities and there are certain challenges. But the way to think about technology is that technology does not exist in isolation. Technology has a way of accelerating or augmenting, the entire infrastructural landscape. So when you think about it from that perspective, you would realize that as a continent, if we do the right things between now and 2050, we can, supercharge the economy from the tech side of things.
Okay, so you've spoken about technology as an accelerator, but the African tech ecosystem you mentioned has no doubt taken off and continues to receive attention, recognition from top players across the world, funding from investors as well. So apart from low internet, we've had issues. You mentioned internet adoption, smartphone adoption, internet penetration, fintech, e-commerce, but we've had issues of low penetration, internet penetration on the continent. What other factors are hampering Africa's transition into tech or adoption of technology?
Yeah, internet penetration is a major problem, but there are certainly other factors. Cost of internet services keeps going very low on the continent, but not at the lowest, and the alternatives are not something to write home about. So, for instance, what is the cost of digital university compared to the traditional ones, or the cost of using a digital bank, when compared to the traditional bank? And I think that this massive and drastic reduction, will drive more than 120 million people to start to use technology, on the continent. Another very important thing to really think about is the new generation that is called the Gen Z, that is evolving, and it's quite very big. Almost 60% of the continent fall within that age bracket. And this is also another market that is very, very, growing very fast. And the economy of the continent kind of like depends on it. If the policy of the government kind of like push these, age brackets off, using multiple technology products, then you would see a decline. So for instance, P2P trading, international transaction is still a major challenge on the continent. Blockchain technology is a crisis in Nigeria. And all these might, decelerate, adoption of technology, on the continent. But on the flip side of things, there are also massive opportunities that is moving these very big, generation to use technology and use it at large.
So we talked about this, the factors probably hampering these adoption. Talked of the government policies, which is one of them. But we have intense global competition as well, which you mentioned Gen Zs. How do you think African young people or young Africans can position themselves, or Africa as a continent can position itself to be the next digital frontier?
Yeah. So we need to crack some very hard parts, of the growth elements. I would narrow these things down to around 4 to 5 things. We need more funding, a better credit system and infrastructure. We need to be much more aggressive with talent development, right? We need much more policies that are pro startups or pro tech. The final thing on my list will be a much more pan-African approach to how we are controlling, country integration, across the continent. In terms of funding, I have been a very big advocate of investing in university students because that is where most of us come from in terms of like building technology companies. We need a better credit system. 30% of businesses that will be created between now and 2050 we rely on a much more robust and better credit system. On talent development as a continent, we need to supercharge, because it's a demand and supply thing. The cost of talent is quite very high today. When you raise money as a startup, almost 40% of the money you raise go into, finding the right talent. I think we can reduce that number a little bit more to about 10 to 15% if we have the right talent ecosystem and we invest more in talent. In terms of Pan-Africanism, my biggest recommendation would be we need to be very, very intentional about integration so that whatever product you're building in Nigeria, can be used in Ghana, in Uganda, in Botswana. And that's where you can reach a scale. Countries like United States, India, China benefit from the size of their markets. And we also need to be much more Pan-African in our approach. It's not useful when you build a product in Uganda and it cannot be used in Egypt or in Nigeria. If we achieve that Pan-African approach and we do that faster, then we can build a much more robust, economy from the tech perspective.
I see that you're talking about scalability of tech in Africa on Pan-African level, which is a bit lacking at the moment. We even see in digital or telecommunications, it's quite hard to communicate from one African country to the other, and we're hoping tech will bring or bridge that gap that we're having at the moment. Thank you so much, Aitayo Ogumola, CEO Itiva, for coming on the program. Now, the World Bank has approved $9 million in funding for the Liberian health sector, a portion of which is to be used for the vaccination of 70% of Liberians across the country. According to the Liberian government, the financing agreement, which is expected to strengthen the country's health sector, will focus on 2 projects, which include Liberia Women Empowerment. The World Bank country manager to Liberia, Dr. Kwima Ntara, explained that the second phase of the COVID-19 emergency response seeks to consolidate the gains Liberia has made in fighting the pandemic. It says the funds will be used to acquire additional cold chain equipment for proper vaccine storage and handling, such as refrigerators and trucks, to ensure an effective rollout of COVID-19 vaccines, as the target population has been expanded to include 12 to 17-year-olds. Now, Tanzanians are bracing for tougher times ahead as fuel prices across the country rose today despite government subsidies. According to the Energy and Water Utilities Regulatory Authority, EWURA, prices for petrol, diesel and kerosene have risen to levels never recorded before in the local market. As from July the 6th, that's today, a litre of petrol now costs 3,220 Tanzanian shillings. That's about $1.38 in Dar es Salaam, up from 2,994 Tanzanian shillings last month, while price of diesel will now be sold at 3,143 Tanzanian shillings from 3,131 Tanzanian shillings. Retail price of kerosene also rose. However, the prices would have been much higher without the government's 100 billion Tanzanian shillings monthly subsidy that began in June last month. Now, Egypt's non-oil private sector economy has suffered its worst performance in 2 years, and that's according to a survey by S&P Global. Egypt's Purchasing Managers Index dropped to 45.2 last month from 47 in May, remaining below the 50 mark that separates growth from contraction for the 19th straight month. This comes as demand slumped after a sharp spike in prices and a pound's devaluation, while businesses struggled to secure the necessary supplies of raw materials. Also, input costs soared at a faster pace for almost 4 years, prompting companies to raise their selling charges the most since February 2017. South African labor groups, the National Union of Metal Workers South Africa, National Union of Mine Workers, and Solidarity have accepted a 7% wage increase from struggling power utility company Eskom to end the workers' strike. The cash-strapped power utility has to find an extra 1 billion rand to the overall wage bill between July 2022 and June 2023. Apart from the 7% wage increase, Eskom workers also have won a 400 rand increase in housing allowance, as well as the reinstatement of the conditions of service. Despite the end of the workers' strike, which was blamed on escalated levels of load shedding to stage 6, Eskom says load shedding will still continue as the national power grid is still under strain. And that's it on the program. I'm Will Ibang. Thanks for watching. Bye for now.